Hi folks, Brett Girard, Portfolio Manager at Liberty here. I hope everyone had a nice weekend. And while we might not have gathered as we usually would have, thank goodness for technology and video chat. We're getting a number of questions about the plan forward. Before we start, let me just be abundantly clear. We are not market timers and we aren't in the business of predicting the path the market will take. Rather, we're fundamental analysts focused on buying attractive companies at attractive prices. Now to start, let's take a look at this updated chart from CNBC. Here you can see from market peak in mid-February to March 23rd, we saw the S&P 500 lose about 34%. Historically, this was the fastest drop over the shortest period the US markets have seen. This drop was the result of a liquidity crisis caused by COVID-19. A liquidity crisis happens when investors are in a rush and often a panic to de-risk their holdings. In practice, that means a flight to safety, which is usually the US dollar. The US dollar is perceived around the world as the safest currency since it's backed by the US government, who in turn owns the world's largest military. Now, investors in the market that were holding anything, including stocks, bonds, and gold that could be sold quickly, did so through this liquidity crisis. This means that the marginal or market price of the securities changed. However, the value may not have. Think about it this way. Let's say your house and your neighbor's house are both worth $1 million. If your neighbor loses their job and has a huge mortgage to pay, they may panic and sell quickly. If the best offer they receive is for $750,000 and they take it, is your home now worth only $750,000? It's unlikely you'd think so unless you were also in a pinch. The same phenomenon happened through the liquidity crisis where investors put their holdings on sale to raise cash. Now you can see by March 23rd, the market bottomed. There was a change in the attitude and it slowed the liquidity crisis. Central banks in Canada, the US, and abroad, through open market actions, directly purchased some of the securities being sold, and this sort of acted like the government coming in and buying your neighbor's house for maybe $900,000. Fiscal stimulus was also announced, whereby impacted businesses, employees, and individuals will receive tax breaks or government checks in the coming weeks to months. And to top it off, there's been increasingly positive data around infection rates and death rates in Italy, Spain, and New York State. This has led to optimism in the market and given way to the recent rally of 28% off the bottom. But let's stop and think about this for a second. The intention of the Flatten the Curve initiative was not to eradicate COVID-19. We would need a vaccine for that. Rather, it was to slow down the number of people getting sick to not overwhelm the healthcare system. Well, we've done a good job of this so far, but we've also implicitly delayed the spread of the virus. If we went back to life pre-COVID-19, we would in turn steepen the curve and be right back into the situation we were trying to avoid. And so, we believe that this shutdown and the restrictions that have come along with it, to be effective, will need to be in place much longer than the market is anticipating. One likely outcome here is an economic crisis where businesses and individuals, key components of the economy outside the government, might not be able to last and are forced to declare bankruptcy or shut down. What we haven't seen is how businesses have fared during the past couple months. And that's all going to change this week as we kick off Q1 earnings. There's big names like JP Morgan, Johnson & Johnson, Goldman Sachs, Citi, and Schlumberger all reporting this week. Now, granted only March will be captured in the financial statements, we will see the impact of 1 month shutdown through March. We'll see guidance from management, and we'll also get an updated look at the corporate balance sheets. This should give us an indication of what we can expect as the curve continues to flatten. So how do we move forward? We believe the stock market right now is over-exuberant on government stimulus and positive news on COVID-19. But in reality, the economy needs to recover before valuations can. In fact, if you look at the data, since market peak in February, we've fallen about 17%. When we see that earnings are reported this week, it's very likely we'll see drops in earnings of more than 17%. So on a valuations basis, if we look at price to earnings, we've seen price fall by 17%. It's unclear how much earnings have fallen, but here's an example. In 2019, for the third week of March, the box office, US movie theaters showing live movies throughout the US, did about $200 million in revenue. For that same week in 2020, the revenue went from $200 million down to about $5,000. This is significant, and this is not exclusive to the box office in the US. So for many companies, it's possible that we'll see earnings drop by more than 17%. This would mean that on a price to earnings basis, or PE ratio basis, we're actually going to have a higher value now than we did pre-market peak. So this just reinforces the fact that we must continue to stick with our plan. As you recall, that means first, keeping your holdings within our agreed upon asset mix. As we've previously discussed, your risk tolerance and time horizon drive asset mix. This is important to maintain both in up years like 2019 and down years like 2020. Next, there are plenty of opportunities in the corporate bond and preferred share market, so you may have seen new holdings added to your portfolio on these fronts. On the equity front, we believe that the market is still overvalued, so we continue to remain invested in what you own, but also hold cash at 20% multiplied by your equity weighting. And finally, in terms of putting the cash into equities, we have established entry prices for each stock that we hold. Our entry prices are well below current market levels. Based on these entry prices, we have calculated how many shares of each stock you will require to result in each of your 30 stocks getting back to a 3.3% weighting. You'll recall that's where we started off your portfolios when you began with Liberty. We've input our entry prices as limit orders. For a little context, there are two ways to buy a stock. One, a market order, which is where you buy a stock at its prevailing market rate. And two, the second way, which is the way that we always use, a limit order. In this case, the limit order is placed and it stands until the price is reached. Our limit orders have been placed well below current market prices so as to take advantage of volatility around earnings and over the upcoming quarters. To end, I would just like to highlight that over the last 10 years, we've heard it's fairly easy to invest. You can put money into an ETF or an index and just watch it grow. That's going to be much harder going forward. Looking at pre-crash data from January of this year, 25% of the publicly traded companies in the US were unprofitable. What do you think that number is going to be now? In a post-COVID-19 world, quality companies like those that you hold are going to thrive. It's never been more important to have the fortress balance sheet and the ability to generate free cash flow. Now you combine that with a capable management team and you'll see the names in your portfolio be strategic and nimble over the next months to years. They're going to be able to buy floundering competitors, they can hire away top talent, and they might even buy back shares at a reasonable price, not at the top. We're going to get through this, and we think this is actually a great opportunity not to trade stocks, but to invest in great companies at great prices. That's the plan, and that's what we'll always strive to do. As always, please feel free to reach out with any questions. David, Annie, and myself are always available to chat. Thank you, and stay safe.